Alrighty. So in today's video, I have for you the ultimate credit spreads trading guide, and this is for you if you're a beginner, right? So if you're just starting out into trading options, then this is definitely the guide for you. Or if you are, new to credit spreads, that means you have been trading options for quite some time, but you have never really dealt into spreads, then this is going to be good for you as well, because I'm going to go in depth into some of the topics, right? So for this video, here is the table of content. So first of all, I'm going to get into what exactly are credit spreads, and also why you should trade credit spreads, and how to enter into a credit spread, how to exit a credit spread, and more importantly, how to manage a losing credit spread. So this is one of the most important topic that a lot of people actually ask about, because inevitably when you enter into one of these credit spreads, sooner or later you will definitely have positions that is like in a drawdown. So this is at a point where you really need to know how to manage it properly. All right, so are you ready? If you're ready, please get a pen and a paper as well, so you can start taking some notes as we go through this video. All right, so let's dive into the very first one. So what exactly are credit spreads? So credit spreads are short option strategies, which is the opposite of long option strategies, that gives you a credit upfront for putting on a trade. So this is one of those terms where you hear, people say it pretty often when they're trading options, and that is selling premium. So if somebody tell you that they are selling premium, then you know that they are trading basically short option strategies where you receive a credit upfront. So this is opposite to long option strategies. So long option strategies, for example, the most basic one is to buy a call option, right? So basically with buying a call option, what you do is that you have to, fork out the funds first to put on the trade, and then once you sell it, you see, what's the price differential. Now, short option strategies is the opposite, where you receive the credit upfront first, right? Now, this credit which you receive is actually put into your trading account immediately, right? And you can actually use it, right? So for example, if I were to sell a credit spread for $1.33, it just means that I will be receiving $133 into my trading account, right? So let's say, for example, if my trading account, let's say I start off with $5,000. Now, after I sell this credit spread, you'll notice that your account suddenly now becomes $5,000 133, right? So you have $5,133, but what you need to understand is that although that they have given you the credit $133, they actually hold a certain amount of money for you to put on the trade, right? This is what you call the buying power reduction. So here's a very important thing to understand when you put on this credit spread. It doesn't mean that you've already profited on the trade. While the premium has already been credited to your account, now the P&L of the trade will only be finalized when the trade has ended. And what do I mean by ended? Ended just means that either you have already closed out your trade or you wait until it expires. So every option has an expiration date. So either one of them, right? Either you close it out or until the trade expires. That is when the trade has ended, and then you see your P&L. So your final amount may not necessarily be this $5,133 that you receive upfront, right? So this is the balance which you have once you put on the trade. Now, once the trade closes, it really depends on whether you have made or lost, right? If let's say, for example, you made the full profit on a trade, right? The trade may be expired out of the money, then this will be your finalized amount. But if you actually, let's say, for example, you only made $33 on the trade, right? Let's say you receive $133, but based on the trade, when you closed it out, you only made $33. So what it means is that your account now will only show $5,033. Now, what if you lost, right? If you lost, this amount could actually drop below $5,000. So how do you know exactly what is your max loss? So you can take a look down here. This is the order ticket for Tasty Trade. Now, it depends on what platform that you're using, but all the platforms should actually show you what's the max loss on your trade. So as you can see down here for this particular trade, the max loss is $367. So if you actually lost money on the trade, then you will see that your account will drop to around 4,000 something, right? So it depends on exactly how much you lose. So again, don't think that because you receive the money up front, that is yours for you to keep right now, right? You still have to wait until the trade actually closes. Now, next, how do you tell whether you are in a profit or a loss, right? Because this is where a lot of beginners, when they just get started into trading credit option strategies or any short option strategies, they get a little bit confused, right? Because most of the time when they get into, trading, or rather if they came from the outright trading world, they are used to seeing, the current price higher than where they first bought it at. So let's say, for example, if you bought it at $1, and then let's say the buck is showing you $1.50, right? This is in terms of, let's say, debit strategies. Let's say you bought a debit strategy, or maybe you buy a call option for $1, and now this call option is worth $1.50. Then now you know that you have made 50 cents, right? So remember, one contract controls 100 of the underlying shares. So it just means that you have made about $50, right? $50 for 50 cents profit, right? 50 cents profit is equals to $50. So this is where many people get confused, because when you're trading credit spreads, it's actually the opposite right now, right? You want to see the opposite. What you want to see is that you want the number to be lower than where you sold it at, right? So let me just remove this drawing down here. So for example, if you sold it at $1.33, like the last example that I show you, what you want to see on the mark, which is the current price of what your trade is, to be lower than $1.33. So for example, if it's at $1, then you know that you have made 33 cents. So to profit on the trade, you have to buy back lower than when you sold it, and it's a loss if you buy back higher than when you sold it, right? That will be a loss. So as you can see down here, there's an example. So again, this is on the Tasty Trade platform. So as you can see on the left hand side, this is where I sold the trade for, right? As you can see down here, it says trade price. So you notice that it's sold for $2.52, and right now it's currently marking, that means the current price is at $1.87. So for this trade, it's in a profit. So as you can see, it shows $65. Now for the one below, you notice that it's $1.38 at where the trade price is. That means when you open up the trade, now it's marking for $1.57, which means to say you're in a loss, right? So remember, if you're trading credit spreads, when you're looking at your positions tab, what you want to see is that the current price is lower than when you first sold it. Then you know that you're in a profit. Now next, there are two types of credit spreads, right? So credit spreads come in two flavors. So we are talking it as though it's like an ice cream or something like that. So you have the bullish flavor, and that is the put credit spread, also known as the bull put spread. So you want to choose the put credit spread if you are bullish on the market. If you think the market is going to go up, then this is where you want to put on a put credit spread. So how do you put on the put credit spread? So it's actually very simple, right? To put on the put credit spread, there's just two options that you have to put on, right? The first one is the short put that you have to put on, right? So as you can see down here, this is the short put, and what you want to do is you want to generally put it out of the money, right? So for the put option, out of the money just means that it's below where the current market price is. So as you can see down here, the current market price is around 194. So out of the money just means it's below, right? And the next option that you want to put on is the long put option. So you want to buy this below where your short put is, and this is where it actually defines your risk, defines your max loss, right? So in this case, if the market actually goes way past, or even if the stock goes all the way to zero, you cannot lose more than where you place this long put option at, right? So what it does is to really limit your loss. So when you're trading the credit spread, it's important that you put these two together at the same time rather than, you spread them out, right? Some people like to put on the short put first and then later on put on the long put. And generally, you don't really want to do that because you get into lagging risk. So you want to put these two together at the same time in one order ticket, okay? So this is for the put credit spread. Now, if you are bearish on the underlying market, that means you think that the market is going to go down, then you want to put on what is called the call credit spread, also known as the bear call spread. So the bear call spread consists of two call options, right? One of them is the short call option. And again, you want to put this out of the money. And for the calls, out of the money is basically above where the current market price is. So you can see the current market price, again, is 194.7. So anything that is out of the money for the call side is above where the market price is. So for this, you want to sell an out of the money call option, and then you want to buy a call option further out of the money, right? So this is above where the short call is. And again, same thing. This is what you call the width of the call spread. That means this is how wide your call spread is. and your loss is also limited to where this long call option is. That means if the market, let's say for example, it shoots to the moon, again, you only can lose up to the point whereby where you place your call option, right? Your long call option. So this is also one of the things, why people say that, selling a naked call option is very dangerous. Why? Because let's say for example, you do not have this call option down here. Then if the market really shoots all the moon, then guess what? You can keep losing money as the market keeps going higher if you do not have this long call option. So when you have this long call option in place, this actually protects you to the upside. So again, very important, you have to put these two at the same time rather than you leg them in, because you could get into legging risk. Now next, how do you know what is the max profit for a credit spread? Now, if you were to just buy a very simple, call option, right? A long call option strategy, then your max profit is basically unlimited, right? Because if the market just keeps going up, then you can just keep profiting on the call option, right? But for the credit spread, is very different. It's the opposite, right? For credit spreads, your max profit is actually already capped, right? And it's capped to the credit that you receive at the start. So for example, I sold this credit spread at $1.33. What it just means is that your max profit is actually this is $133 per credit spread that you put on, right? So if you're not sure exactly what is the max profit, all you have to do again is just pull up your order ticket, right? Your order ticket, as you can see, it shows $133. Now, how do you know what is your max loss? So the max loss is actually also pretty simple to calculate. All you have to do is first, you have to know what is the width of your spread. So as you can see down here, the width of the spread is $5 wide. $5 wide. So again, for each contract that you put on, it controls 100 shares. So there's $500. $500 loss minus the credit that you receive. So in this case, it's 500 minus $133. And that's where you get the max loss of $367. So this is pretty simple to calculate, right? If you don't want to calculate this by yourself, of course, just go ahead to take a look at the order ticket. Now, this is something that you have to understand when you're trading credit spread, right? Some people will be asking, if the risk to reward ratio is so bad, why do you want to trade the credit spread? Because if you notice, your max profit is $133, but your max loss is $367. So in a sense whereby every time when you lose the max loss, you need quite a number of the max profit in order for you to recover that loss, right? So I'm pretty sure you're asking that question, right? And the reason why you want to trade a credit spread, and something that not many people actually notice, is the profit probability, right? The probability of profit down here, as you can see, is 60%, right? Most of the time when you put on a normal trading strategy, let's say for example, like if you go to outright trading, you just buy a share, that would be a 50% probability, right? Because the moment where you first buy so let's say for example, the stock is down here, this is where the current price is. The moment where you buy at this point down here, there's a 50% chance of whether you make money or loss, right? Because if it goes up, 50% of the time you make, goes down, 50% of the time you lose money. Now, of course, we don't want to take into, the fact that maybe you have some strategy that is going to work out in the long term where, you have an edge in technical analysis. Let's put that all aside for now. Let's just take a look simply at price, right? Simply at price, when you enter at this point down here, there's a 50% it will go up, 50% it will go down. That is why it's a 50% win rate strategy. Now, for the credit spread, it's very different, right? So if you take a look at this put credit spread as an example, you notice that the current price is here, but your put credit spread is below here, right? So what does this mean? It means that if the market actually comes down, and let's say, for example, at this point, it expires, right? It expires, that means the trade has finalized. So do you actually win or lose money at this point? Well, the answer is that you actually made money on this trade, because although it has gone down, it did not go below this short put strike. So anything that is above your short put strike at expiration, it's a profit. So what you notice down here, which is very different from outright trading, if the market goes down, you could actually still be in profit, right? So that is why there is the higher probability of profit. Now, the other thing to understand is that some people actually calculate expectancy, right? That means they will take the probability of win times the average profit, and then the minus of the probability of loss times the average loss. Now, you don't want to use the numbers down here to calculate your expectancy, because it's not accurate, right? Because it's not definite that let's say for example, you see 60% is profit. It's not that 60% of the time, right, 0.6 or rather 60%. All right, let me just remove all this drawing to make it much clearer. It doesn't mean that 60% of the time you will definitely make $133, and doesn't mean that 40% of the time when you lose, you will be guaranteed a $367 loss. No, it's not like that, right? Because there are varying profit levels and varying loss level. The trade may be, for example, a profit of only $100 at one point at one time, or maybe your next trade could be $50 profit only, right? So you need to take the average of that and also the loss as well, right? So let me put a minus down here to be clear. So it's not every time you lose the max profit, right? The only time you can lose the max profit is if the market goes all the way down here and at expiration, right, this trade closes below this long put option, right? Only at expiration. If you close out before that, it may not necessarily be a max loss. So this is something I'm going to be talking about later on, how to actually exit the trade, because not all the time you actually want to exit at expiration, right? That's where, quite a number of new traders make the mistake, right? They think that they have to hold the trade all the way to expiration. So it's either you make some money, the max profit, or the max loss, right? That's not true, right? So the only time you can lose money on this trade is if the max loss is realized at expiration where the market is below this long put strike. Now, there are times whereby it actually doesn't go below this long put strike. For example, it could go down here and it expires, right? So if it expires down here, this is where it settles at. You notice it's not below this long put strike down here. If it's not below this long put strike, you actually do not realize the max loss, right? It's somewhere in between. So that is why it's important to not calculate, your win and loss or the probability of whether you make money on credit spreads based on this number here. You actually have to trade them out, and based on your numbers, you calculate exactly what is that expectancy. Now, that's the other thing I want to talk about is in terms of this probability of profit. How you actually increase this probability of profit, it depends on how far away you are from the current market, right? So for example, this is the put credit spread. Let's use this example again. So let's say at this point in time, let's say this is a 60% win rate probability in terms of this put credit spread. Now, for you to increase this win rate, all you have to do is actually push this put credit spread down. That means instead of selling this put credit spread here, you're selling your put credit spread down here instead, right? You have a much further away put credit spread. Then from here, your win rate will increase. Maybe it could go all the way to 75% or 80%, depending on how far away the market is. So for those who want very high win rate, you might be inclined to actually put your put spread very far away from the market. This way you get to win most of the time, right? But don't forget that it's actually a trade-off, right? The trade-off is that although your probability of profit may increase, but your risk-reward ratio actually becomes even worse, right? Your risk-reward ratio may now become where your max profit is only 50 cents, and then your max loss is $4.50 in terms of a $5 wide spread, right? Which means to say your max loss is $450, your max profit is $50. So this is the trade-off, guys, right? If you want a higher win rate, you have to settle for a lower profit but a higher max loss. So the whole idea down here is not to think of something like what is the best credit spread to put on, but rather, you want to find a good balance between both of them. So in terms of a credit spread, what is a good balance? So that is what I'm going to touch on in the later slides. But for now, the next thing I want to touch on is why trade credit spreads, right? So I'm going to give you a few reasons. Well, the first reason is that you don't have to be right on the direction and you can still be profitable, right? Like I mentioned earlier, if the market actually comes down and it expires down here, you're actually still in a profit, right? You notice that you are wrong on the direction, right? You think that the market is going to go up, but instead the market went down, but because it didn't go low enough past this short put strike, it expired out of the money, you're still in profit, right? So this is the edge actually you have compared to, just outright trading where it's 50% short, or even just buying a long call, which is the worst way to actually get into a bullish trade, right? You definitely do not want to just go into a long out of the money call. So to be profitable on a credit spread, you don't necessarily have to be 100% right on the direction. You just have to not be severely wrong on the direction, right? You can be still wrong on the direction. Just make sure that you're not so wrong that it goes all the way past down there. All right. So this is the first reason. Now, the next reason is that it actually has a high win rate compared to outright trading or even just buying out of the money call options, right? So as you can see down here, the win rate is very high. So this is a study done by the Tasty Trade research team where they tested the 20 delta put spread, right? The 20 delta put credit spread. As you can see down here, the win rate is pretty impressive, right? You have for $1 wide, $5 wide, $10 wide. So regardless how wide it is, you can see the win rate is above 90% for most of them, right? You can see it's pretty high. So this is the kind of win rate that you cannot get in outright trading or even just buying an outright call option, right? Out of the money call option. So if you want to win more often than you lose, then definitely you want to go for the credit spread. Now, the next reason is that it's easier to construct a credit spread compared to other option strategies like the Iron Condor, the Butterfly, and the Broken Wing Butterfly, right? Because the credit spread only has two legs, right? You only have the short leg, which is the first one you normally should want to put on, and then you have the long strike, the long put option, right? For the put spread, right? So this, as you can see, is the put option. The put credit spread. The call credit spread is just the same as well. You have two strikes as well. But basically for credit spreads, there's just two strikes for you to handle, right? To manage. Very simple, easy to construct. And the next and very important reason is that it has limited risk, right? The risk is kept to what you define as the risk at the start, unlike undefined risk strategies. Let's say, for example, if you put a short put, if the market keeps going down, then you're going to keep losing money as the market goes down, similar to the strangle or the put ratio spread as well. But if you have a credit spread on, or in this case, the put credit spread on, your max loss is kept basically to where the long strike is. So that means the market can, just go all the way to zero. You still won't lose more than whatever you risk on this trade, which is up to this point down here. So it's very good for you to get started, especially, if you're new to trading options. And finally, it's a very great way to get started if you have a small starting capital, right? Maybe you don't have that much funds, or maybe if you're just starting out just to test trading options, you can definitely trade credit spreads, right? Credit spreads is not capital intensive, and you can put on a trade for as little as maybe about, I would say about $300 to $400 on a trade based on, a $5 wide spread, right? So if this is a $5 wide spread, and according to the example I shared with you earlier, right, let's say you receive $133 or $1.33 for this credit, then your max loss is only $367, right? That means you only have to put up $367 per trade for this trade for you to put it on, right? So if you have a small account, this is perfect for you. Now, let's get into how you're going to enter into a credit spread. By the way, if you like this video so far, please subscribe and also click the thumbs up button. And also do get your free copy of the Options Income Blueprint, where I share the top 3 option strategies that help you generate a consistent income each month, trading just 1 to 2 hours a day, right? So if you want to go ahead to get this copy, just head on over to optionswithdavis.com/blueprint. All right, back to the video. So I'm going to give you a few simple steps to get started. So if you have a pen and paper, this is time for you to write it down. So the very first step is to pick a direction, right? Remember, the credit spread comes in 2 flavors. You have the bullish flavor, which is the bull put spread, and you have the bearish flavor, which is the bear call spread. So you have to first decide whether you think the market is going to go up or down. So if you're bullish, then go with the put credit spread, right? Also known as the bull put spread. Now, if you're not good at reading charts or technical analysis, then one simple way for you to get started is just by using what is called the stochastic oscillator, right? The stochastic oscillator, or the RSI. So basically, these are indicators that just help you indicate whether the market is overbought, oversold, right? So anything below this line down here is considered oversold, and anything above this line down here is considered overbought, right? So as a general rule of thumb, if the market goes to a point where it's oversold, right, then that means it dips below this line down here, then this will be the time where you can consider putting on a put credit spread, where you want to get a little bit more bullish rather than bearish. Now, one thing to understand again, and I explained this in many of my videos when I talk about the stochastic oscillator, is that this is not some kind of a miracle or magic indicator, right? It's not like every time when it's oversold, the market will definitely bounce up, right? There'll be times where the indicator shows it's oversold and the market continues to go down, right? right? That happens, right? You just need to understand that strategically speaking, if you want to put on a bullish spread, do you think it's smarter for us to put it on when the market shows that it's oversold or when it's overbought, right? So generally, we want to be, a little bit smarter when it comes to, placing bullish or bearish strategies. So this at least will help us, put the odds in our favor. So one simple way, just take a look at this stochastic oscillator. If it's oversold, then you can start to think about putting on the put credit spread. Maybe this is where you might take a look at where the support is. This is where you can start to look into putting on a put credit spread. And if you're bearish, then you can go with the call credit spread. So basically, same thing. If you're not sure when is a good time to put on the call credit spread, then just take a look at the indicator, right? The stochastic indicator or the RSI. Once it's overbought, then you can start to consider putting on a call credit spread, maybe somewhere up here, right? So you can see the market has already gone up quite high. So at this point of time, it looks a little bit exhausted. At the same time, there's some resistance down here. So I would say that, putting a call credit spread above this line down here, would be pretty strategic. At the same time, you can see it's overbought, right? So this is how you would pick a direction. Now, some people have asked me, hey, Davis, what is your setting for stochastics? So I already mentioned this in another video. You just go to my channel and search for stochastic. And then you'll find a video where I already just go into how you set it up on your chart. Now, next step number 2 is to choose your DTE. So DTE just stands for days to expiration. So as you can see, there are many different expiration dates for you to choose from on this option chain. So how do you decide which DTE? Now, some people like to go very short term, right? Because they think that, by going very short term, you can get slightly higher premium in terms of percentage return is higher. And also, you can, sell the credit spread more often. That means, let's say, for example, if you choose something like 12 DTE, 12 days gone past, you put on another one again, right? But for me personally, I prefer to go for a longer term one around 45 DTE. That is because studies have already shown that you have an edge when you go around the 45 DTE. So if you want to have an edge in the long term, then I will go for somewhere around 45 to 65 DTE. So what is this edge, right? So as you can see down here, this is a study done by the Tasty Trade team again. So they have studied the difference between the expected and the realized move for quite a number of years. As you can see, this study is since 1993, so this pretty statistical significant kind of a test set. What you have to understand down here is that when we're trading short options, a lot of time, right, we want the fact that the expected move has to be greater than the realized move. That is where our edge is, right? So if you're not very familiar with this term expected move, I suggest you go to my channel, right? I already created a video very in-depth on it and why we want to use that as our edge when we're trading options, right? The video is called the #1 secret to becoming consistently profitable trading options. I'll put the link at the top right hand corner of this video if you haven't already watched that. Now, when we are trading options, we want to always ensure that the expected move is greater than the realized move. So this way we know that we have an edge, right? But if you notice down here, if we choose the days that is below 45 days, right, you can see that anywhere from 30 days all the way to 7 days down here that they have shown, there's no edge, right? You can see the question down here they ask is expected bigger than realized. The answer is no, right? If it's no, it just means that we don't have an edge here. But whereas from 45 days onwards, right, as you can see down here, 45 all the way to 90 days, you see that the expected move, is it bigger than the realized? And the answer is yes. It shows that you actually have an edge when we are trading the longer term DTE, right? So you can see down here, average expected move for the 45 days is 5.7%. So this is what the market expects it will move in the next, say, 45 days. But the average realized move that it actually happened, that means the actual move is only 5.2%. That means it moved actually slightly smaller than the expected move. And this is important for us when we're trading, short option strategies, because we do not want the market to move that much, right? We want the underlying to stay as small as possible or in the direction of our trade, in this case for our credit spreads, right? So for example, if you put on a put credit spread, we want it to go up, right, all the way up, or if it doesn't go up, at least, don't move that much against us. So when you have this edge, then at least when you put on a put credit spread or call credit spread, more often of the time, the trade will work out for us rather than it not working out. And let's say if it does go against us, at least it won't go that far, right? So that is why I prefer to choose around 45 to 65 days. I don't like to go any further out than that, because if you go too far out, then theta is not really going to kick in, right? So we want time decay to work on our side. So any time between 45 to 65 days would be good. Now, step number 3, and that is to decide on your short delta. So when you're putting on a credit spread, the very first thing you have to decide on is the short strike, right? So if you're doing the put credit spread, you have to decide on your short put. If you're doing the call credit spread, you have to decide on the short call option. So for here, if you have a strong conviction on the underlying direction, go for a higher delta. So in this example, we are using the put credit spread as an example. So that means that you want to go somewhere from around 40 deltas to 30 deltas if you're pretty strong in your conviction, right? And if you're not that strong, if you're a little bit more conservative, you want a higher win rate, then you go anywhere around 30 to 20 delta, something like that, right? Remember, again, there's always a trade-off, right? If you go for like 20 delta, now of course you're going to win more often of the time, but whenever you have a loss, it's going to be pretty big as well. So it's a trade-off. So for me, I think somewhere good would be around 30 deltas. That's also where the Tasty Trade team, the research team, have done most of the tests, right? They've done a lot of tests regarding the 30 delta. So as you can see down here, this put spread test which they have done is, if I'm not mistaken, is around 30 deltas or so, right? This is a put spread strategy. So as you can see down here, they did a test for $5 wide, $10 wide, and they also tested it at expiration and also where they exit the trade early, right? Where you exit the trade early, basically it just means they exit at 21 DTE, right? It means that there's 21 days left until the expiration of the option. Then they take off the trade, right? As you can see in both cases, it's still profitable, right? You can see the annual ROC, but what you notice is that if you were to manage earlier, you get a slightly lower win rate, right? But your annual return is slightly higher. And again, as you can see down here, this is another test which they did. And you can see in the long term, this is for the put credit spread, you actually have an edge in the market, right? Because the market keeps going up and if you're putting on a bullish trade, now, of course, you're going to be profitable on it in the long term. But how profitable? There are two ways, right? You have the 21 DTE and you have the one where you hold all the way to expiration, right? But basically, for this is when you're choosing your short delta, you want to choose something where you're comfortable with, right? If you want more credit, go for a higher delta. If you want a higher win rate, go for a slightly lower delta. Now, step number 4. Once you've already decided on your short option, how do you define the long option, right? This is what is called define your long wings. So the way to do it is to base it on your max risk per trade. So the very first thing you want to do before you enter into trade is you need to decide, what is the max risk you want to risk for the trade. So let's say, for example, you've decided that $500 is the max risk you want to put on the trade. So the first thing you would do is just go 5-point wide first, right? Just go 5-point wide first and then start to construct it from there as a starting point, then adjust it, right? So let's say, for example, you put on a $5 wide put spread in this case, and you see that the premium which you receive is $1.25. Now, if you were to take a look at the max loss is actually only $3.75, which is $375 per contract, right? So you notice that it's still a little bit shy from your $500 max risk. That means you still have about $125 risk that you can put on. But at the same time, you cannot go 2 contracts, right? If you go 2 contracts, you will way exceed 500 because now it will become around $750. So what do you do in this case? So in this case, what you want to do is just simply widen out your width, right? So now instead of 5-point wide, you stretch that long option to additional $1 wide. So from here, as you can see, if you put on a $6 wide spread, take a look at your premium first. You receive $1.50 and your max risk now is $4.50, which is $450 per contract, which is pretty close to the max risk that you have already decided that you want for this trade, right? So once you're comfortable with this, all you have to do is put on the trade. Okay, so this is how you actually define your wings. Now that you've already constructed your credit spread, The next step is to adjust your credit, right? So they will give you a credit at the start. So generally what I like to do is I like to adjust my credit spread slightly higher than the mid price. So as you can see down here, they're saying that I can get $1.97. So generally what I like to do is just push it a little bit more to the right hand side. That means try and get a slightly higher credit. And in this case, maybe I might go for something like $1.99. Now, what you want to understand here is that there's a natural price down here, net. Net just means the natural price that you will surely get filled. Now, this is the price where you do not want to choose at the start because this is the worst fill that you can get, right? Instead, go for something around the mid price first. And then you have two options, right? The first thing is that you could just wait to get filled, right? You can just wait until the market, starts trading at this price for your credit spread and then you get filled. Or if you want to get filled immediately, then this is where you want to adjust until you get filled, right? So let's say, for example, you start out with $1.99. What I'll do is I'll send the trade in. And then if within a few seconds, I do not get filled, what I'll do is that I'll adjust my credit down, right? I'll adjust it bit by bit, right? So maybe in this case, I might adjust to 198. Then if I don't get filled, I adjust to 197. If I don't get filled, I adjust to 196. If I don't get filled, I adjust to $1.95, so on and so forth until I can finally get filled. All right. So these are the 5 steps for you to enter into a credit spread. Now that we have entered into the credit spread, the next question you might be asking is, Davis, how do you exit the credit spread right now? All right, so I'm going to give you 5 methods, right? 5 ways for you to exit a credit spread. Now, the very first method is to hold to expiration. So as you can see here, this is a table that I showed you earlier on, whereby they did the test on the SPY and they put on the 20 delta put spread. And as you can see here, if you hold all the way to expiration, it's still a profit, right? You take a look at the daily P&L. This is daily average P&L. You can see that overall it's still in a profit, which is not bad, right? But a slightly better way for you to exit a credit spread might be method number 2, and that is to take profit at 50% or hold till expiration, whichever comes first, right? So for example, if you sold the credit spread, let's say you sold it at $2, right? So basically, what you want to do is that you want to exit the trade once it is marking for $1. Right? If it's marking for $1, this is where you take profit, exit the trade. Right? But if it doesn't reach $1, let's say for example, the moment you put it on, it never reaches $1, and then let's say for example, it keeps going up. This is where you can hold all the way to expiration. So in this case, you can see that the daily P&L is actually higher, right? Which means to say that if you were to take profit at 50% or hold to expiration, whichever comes first, then you're definitely going to have a better results than holding to expiration. Now, method number 3 is to exit at 21 DTE. Now, this is a study done also by the Tasty Trade research team where they came out with a 21 DTE exit point. And what they found out is that when you exit at 21 DTE, you actually have pretty good results, right? As you can see down here at 21 DTE, both your annual ROC is higher than if you were to hold to expiration, right? But the thing is that you will have a slightly lower win rate, right? If you hold to expiration, you have a higher win rate, right? You have 90% win rate. But if you were to exit earlier, your win rate is around 80%. But that doesn't mean that your results are worse. In fact, your results are actually better. And the reason is because you notice that you control your losses actually much better than if you were to hold to expiration. Because if you hold to expiration, then your losses get pretty big. But if you were to exit at 21 DTE, what they found out is that you can really control your loss pretty well. So that is why your average loss turns out to be so much lesser than the average loss if you hold to expiration, which makes the whole trade overall much more profitable in the long term, although you have a lower win rate. Now, method number 4 is a combination of taking profit at 50% or exiting at 21 DTE. So it's similar to method number 2, right? You notice method number 2 is take profit at 50% or hold to expiration. So hold to expiration is the threshold, right? It's the longest holding point. Whereas for method 4, the longest holding point will be up to the 21 DTE marks. That means to say if by the time your trade reaches the 21 DTE mark, that means there's 21 days left to expiration, and you're not at the 50% profit point, then you close the trade, right? Even though it's a loss. So as you can see in this study down here, now you notice that it says 16 delta puts, right? So I haven't seen a study for the put spread, or maybe I haven't found it yet because I haven't gone through all of their videos just yet. But basically, it's going to be pretty similar, right? Short put and put spread is a similar strategy where it's bullish, although the results may just slightly differ. But the results shouldn't be that far in terms of the difference between the, managing at 21 DTE, which is earlier, managing at 50% of expiration, or the combo, right? So the combo is basically the method number 4. So you notice that all three are still higher than holding to expiration. So if you were to choose a method for exiting the trade, you definitely want to choose either method 2, 3, or 4. All right. Now the last method can actually give you a better win rate or a much. Now method number 5 is discretionary exit. Now, this is based on maybe you have technical analysis, or maybe you like to see news, or you have some indicators that maybe it tells you to get out of the trade, right? So this is what I call discretionary exit. Now, as for the result of this, it's very, very hard to tell because it's discretionary. And if it's discretionary, it's 100% reliant on you as the trader for the final result, right? So discretionary exit can actually yield better results than, method 1 to 4 if you're very on point, right? You're very in tune to the market, right? I know of such a trader when, back then when I was in a proprietary trading firm, I know of a trader that is very discretionary in his exits, right? He can exit a trade when he feels something is not right, but he can't tell you what is not right, right? He can't put it into words, but he know that, the market may go against his trade now, so it's time for him to exit. So he's actually doing pretty well. It's one of the most profitable traders then. But to actually be very good at discretionary exit, it's very, very difficult, right? You need to have very, many years of experience in the market trading, then you have this kind of feel. But if you're just starting out, it's best to stick to, one of the above methods, especially 2, 3, or 4. This way, it's much easier for you to know the results, right? Especially since studies have already been done on it, right? We already know that the studies have been proven that in the long term, you stick to these mechanics, you're going to be net profitable in the long term. But whereas for method 5, you're never going to know because in the end, it's all 100% up to you. All right. So these are the 5 methods to exit a credit spread. Now, the next topic we're going to touch on is how to manage losing credit spreads. And that is one of the most asked topic that I have on my channel as well is, what do you do if your credit spread is currently, in a drawdown, right? You see, is it losing money right now? Should you hold it? Should you roll it? Should you close it? What should you do? All right. So I'm going to give you with a number of scenarios, and then let's just work it out together. All right. To see which is the best option. All right. So this is the trade, right? So just imagine that you're putting on a bull put spread, right? So this is a $5 wide bull put spread. You have it down here, as you can see, it's the 175, 170, and there's 50 DTE on this trade, and the premium which you receive is $1.30, right? So there'll be a number of scenarios that you will face as you are trading this bull put spread. So the very first scenario that you will experience is that the market went down, but it did not test your short strike, right? But although it did not test your short strike, your bull put spread is now worth $1.60. Right, and now there's 40 DTE left, which means to say you're actually down about $30, right? So if you do the math, you'll be able to see this, right? So you sold it at $1.30. It's right now marking at $1.60. That means you're at a loss of about 30 cents, which is $30. So at this point of time, what do, right? There's still 40 days to expiration left. So should you be holding, rolling, or closing at this point? Now, for me personally, I would just still hold on to trade because it's still not at 21 DTE, and at this point it's still too early, right? I still want to let theta decay work. Remember, when you're trading credit spreads, any short option strategies, we are making use of theta, right? So although the market has went down, you're in a loss, you do not have to panic, right? It's not even near your short put strike right now. You just have to let theta work. So even though if you hold all the way to expiration and it expires, just slightly above your short put, maybe let's say it expires around 176, which is above your short put strike of 175, you're still going to be profitable, right? So there's no need to panic as of this point. All you have to do right now is simply just hold it. Now, scenario number 2. Now, what if the market has actually gone down and now has already tested your short put strike, right? And your bull put spread is now worth $1.90 and you have 40 DTE left. So at this point in time, your loss is how much? is $60, right? Because your loss is about 60 cents right now. So at this point, do you hold, do you roll, or do you close? So for me, the answer would be to just hold the trade. Again, it's still not at 21 DTE. So remember the table that I showed you earlier on. If you were to just exit at 21 DTE without even managing your profits at all, you're still going to get pretty good results. So this is my threshold, the latest point at where I plan to exit, right, my trade. So in this case, then there's nothing for me to do, right? I'm just going to hold it until it reaches 21 DTE, then I'll decide, right? At the meanwhile, I'm just going to continue to let theta decay do its work. Now, scenario number 3. So this time, the market actually went down. Same thing, it tested your short strike. Your bull-put spread right now is $1.80. So that means you are now down $50. But this time, there's 21 DTE, right? So what do you do, right? So in this scenario, there are actually two viable options, right? The first thing is that you could actually roll. There's actually 21 DTE left. So if you were to roll it, it's possible that you could get it somewhere around the 45 DTE mark, which is again our optimal DTE that we want to go for, where we have an edge. So definitely rolling is possible, but you need to understand is that when you're rolling the trade, right now, what you're doing is that you're closing out your existing trade for a loss and then selling another trade at this time around a 50% win rate, right? Because right now, the market is currently at where your short put strike is. So if you're around a short put strike is, your win rate is roughly around 50 to maybe 55%, somewhere around there. But when you first put on the trade, most likely it should be higher, right? Maybe it's around 70% win rate if you chose something like a 30 delta put spread. So right now, you have to settle for a lower win rate trade, right? So whether you want to roll or not, this really comes down to you. I generally don't want to roll. Instead, I would just close out the trade because I want to be mechanical, right? Because if I were to close out the trade right now, I know that statistics have already shown that I have an edge. So that is why for me personally, if it comes to 21 DTE, I'll just mechanically just close out the trade. Now, what about holding the trade, right? So some people could say that, hey, I want to hold the trade because I think that the market might bounce back up. So you definitely can still hold on to trade, especially if you have a gut feel that, you know, the market is going to go up. But what you need to understand is the risks involved in holding on to this trade at this point in time, right? Because the market may bounce up and then you could profit, yes, but there's also the possibility that the market can continue going down. And if it continues to go down, that will further deepen your losses when you could have gotten out earlier to cut your losses short. And at this point in time, because it's also past 21 DTE, and as the market goes down, now you have an increased risk of getting a sign on your short put, right? So if you get a sign on a short put, it means that you will now be long 100 shares, and that may get you into margin call if you don't have the enough, the funds to actually purchase 100 shares of the underlying. So this is also pretty important for you to understand when you're thinking of holding on the trade past the 21 DTE mark. Now, scenario number 4. So scenario number 4 is now the market went down to test your long put strike at $170 or lower, and your bull put spread is now worth $3 with 30 DTE left. So right now, you're in a pretty big loss, right? So if it's marking right now for $3, it just means right now you are down $170, right? So $170. You're down and there's 30 DTE left. So at this point of time, what exactly do you do? So for me, the answer is actually to just hold it, right? And the main reason for this is because there is still 30 DTE left and it has not reached my threshold of 21 DTE. So remember, if let's say, for example, you're going for method 4, which I mentioned is 50% take profit or 21 DTE. So at this point, you notice that none of these two conditions have been met yet, right? So if none of these conditions have been met, all I do is just hold on to it because the market could just bounce back up in the next few days. And if it does bounce up in the next few days, then there's a possibility that it could also reach the 50% take profit if it bounces up high enough. But if it continues to go down, then I also do not really have to worry also because I already know that my max loss has been kept. And at the same time, I'm going to lean on the statistic that 21 DTE is going to be superior performance in the long term than compared to holding to expiration, right? So the worst case scenario for me is at 21 DTE. So as long as it has not reached either of these two, I'm just staying into the trade. All right, so we've come to the last scenario, and last scenario, scenario number 5, is now the market went down to test your long put strike at 170 or lower, which is similar to scenario number 4. But now your bull put spread is having a bigger loss because right now there's 21 DTE left, right? So days have passed, the market did not bounce back up, it's still below your long put strike. So what do you do at this point in time? Do you hold, do you roll, or do you close? So for me at this point of time, I'm just going to be mechanical and I'm just going to close out the trade, right? Because I know, again, the long-term statistics have already shown that we're going to get a better performance if we just close it out at around 21 DTE. And you also get to manage your loss, right? You can see down here again, your average loss is going to be much less than if you're going to hold it to expiration. Because the biggest risk right now is what if the market continues to, go further and all of a sudden, you could lose the max loss on this trade, right? If you lose the max loss on this trade, it just means it's going to take a little bit more wins the next few times for you to recover this loss. So right now, I might actually just, take the loss down here. Now, with that said, there's actually the argument that you can actually still hold on to this trade right now, even though it's at 21 DT and the market has gone, way past your long put strike. And the argument is that if it's already deep in the money, then there's not much left to lose, right? Let's say, for example, there's only $50 left or less to lose on the trade. Right? That means no matter how long that you hold on to this trade, even though you hold it to expiration, the most that you can additionally lose is only $50. So some people might say that, hey, I already held it until so long, there's only $50 left, and then there's so much more to gain from that point, because if the market really reverses and goes back up, then now suddenly my risk to reward is so good. So at this point of time, can you actually hold it? Then the answer is actually yes. You can choose to hold it, especially, there's not much loss left you can have if you continue holding on to this trade. But one thing you need to really remember is that because it's also now deep in the money, that means your short put strike is also deep in the money, there's also an increased chance that you might get exercise on this short put. So this is one thing to really understand. So if you get actually a sign on this short put, then this is where you need to know how to reverse it, right? Reverse this trade. And for this, I actually already created a video on this. I called it the credit spread reversal strategy, the bull put spread reversal strategy. And I will just link the video on the top right hand corner of this video so you can go and watch that in case you get a sign. At least you know what to do. Alright, so this is the ultimate credit spread trading guide, and I hope you guys really liked it. And if you do, please give me a thumbs up on this video. And if you've gotten good results from this trading guide, please share your results with me as well. I love to hear your success story. By the way, if you like this video, then you're absolutely going to love this next video which I have for you. So go ahead and watch that video right now. Also, if you haven't already gotten your free copy of the Options Income Blueprint, you can do so just by clicking this link down here on your screen, and you'll be able to get it for free. Alright, I will see you in the next video.